On Point with Craig's Investment Partners.
Right, good morning all. Remember, the information provided here is general in nature. It's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor, and you can find out more about what we do in that regard here at Craig's by going to our website, which is craigsip.com. All right, we're pretty much at the middle of the year. Shortest day was just last week, and June is just about to finish. So I thought not a bad time to just do a bit of a mid-year market stock take, see where we're at, see how the first half has gone, have a think about what we should be keeping an eye out for over the second half. So first of all, let's just do a bit of a recap. Looking back on 2022, cast your mind back to the beginning of this year, and we'd just come off a really difficult one for investors right across the board. Most things were down, just about everything was down. New Zealand shares fell 12%, US shares fell 18%. Those were the worst declines that we'd seen in a calendar year since 2008. House prices in New Zealand slumped 14%. That's the worst 12-month period we've seen in history for the New Zealand housing market, in nominal terms at least. And you also had conservative assets, which took a big hit. So New Zealand fixed income, corporate bonds were down 5.1%. That's based on the NZX Corporate Bond Index, investment grade corporate bond index. US Treasury bonds were down about 12%. So everything was down right across the board. And it's really rare actually to find a time where shares and bonds, either in the US or here in New Zealand, are both down at the same time, because normally one's going up if the other isn't. So you think back to periods of difficult periods for share markets through history, whether it's the COVID period, whether it's the GFC, whether it's other recessions. Usually during those periods, bonds are performing well, even though shares and property aren't. So last year was an unusual year because you had the conservative assets going down at the same time that the higher risk, higher return assets were going down. And in fact, before last year, you need to go back to 1994 to find a time when you had shares and bonds in either of those countries down at the same time. So that's 28 years ago. So it doesn't happen every day. And against that backdrop, we were sitting here in early January looking ahead, and most of us were thinking, probably going to be another challenging one, isn't it? You've got slower economic growth that's coming through. We've got more interest rate hikes to come. In New Zealand, the OCR was sitting at 4.25, which was a lot higher than it started 2022. It started 2022 at 0.75, and then it ended 22 at 4.25, and we knew there was a bit more to come. In the US, they had gone from 0.25 right up to 4.5 over the course of last year. So we're sitting here at the start of the year, they're at 4.5. We know there's more to come. So you've got slower growth ahead, you've got more interest rate hikes. All of that was expected to pressure markets, and we were expecting a difficult year. In some ways, it still has been a difficult year, but it's also been a lot better for investors than many people would have expected. So, as we sit here at the halfway point, and we're a couple of days out from the end of June, so these numbers all change. As we sort of move through to this weekend. I'm doing this a couple of days early, so there or thereabouts though. But at the halfway point, world shares today are up 10.6%. So that's world share markets, not including dividends, 10.6%. And they're about 22% higher than the lows that they reached in October last year. So they're still not quite back to where they got to at their absolute peak, which was November 2021. They're still about 11 or 12% below those levels, but up 22% from the lows in October, and up 10 or 11% this year, which is not a bad return at all. And that's, of course, in local currencies, US dollars and so forth. New Zealand investors have seen those returns boosted even further by favourable currency moves, because we've seen the Kiwi dollar fall against the Aussie dollar, the US dollar, the pound, and the euro. Some of those falls have been quite significant. The Kiwi's down 7.5% against the pound, nearly 5% against the euro, nearly 3% against the US dollar. So if we look at the S&P 500 in the US, that index is up 13% this year. And in New Zealand dollar terms, that 13% turns into about 16.5. So the returns have been very strong from many of those international markets. That trend could continue, that currency trend, that is. Our Reserve Bank pretty close to having finished with their interest rate hikes. We're certainly much closer to being done than many others in Australia, in the UK, in Europe. Even in the United States, they probably have more to do than we have. And what that could mean is that you could see those interest rates in other countries sort of push higher relative to ours, which could mean that our currency stays under a little bit of pressure, which would not only be good for exporters, but it would be good for New Zealand investors and international shares. So that's something we're watching too. The local share market, so that's world shares I'm talking about, up 10%. Local shares haven't been quite as strong. We've been a bit more subdued. We're only up 1 or 2%, but up is up, and we'll take that after a difficult year last year. We're about 10% above our low point, which came in the middle of June last year, so almost bang on a year ago. So if you look at your portfolio of New Zealand shares, it probably looks pretty good on a trailing 12-month basis, because the lows were almost bang on 12 months ago. Of those other markets out there, Japan is one of the ones that's out in front of the major markets. Japanese shares are up 19%, so having a very good year. And the US, as I mentioned, isn't far behind, having rallied 13 or 14%, depending on which day you sort of run your numbers. But that's a good return at the halfway point. Back in January, I remember running through all of the Wall Street predictions, and I took the sort of 15 forecasts that all the big investment banks and Wall Street firms had, and the average prediction was for a gain this year of 6% from US shares. They had the average S&P 500 was on average expected to close at 4070 points, which would have been about 6% higher than where it started the year. So 6% for the whole year on average, and we're up sort of 13 or 14%, and we're only 6 months in. So it's been a very, very good return. In fact, there was only one forecaster, and that was Deutsche Bank. They were the most optimistic. They had an end of year target of 4,500, and sort of there. Apart from them, the market is already ahead of where everyone else thought it would be. Then again, look, take those forecasts with a grain of salt. I never put a whole lot of weight in them. Nobody's crystal ball works perfectly, no matter how good you are at running all your spreadsheet models, or how many sort of PhD analysts you've got in your team. Look at last year, 2022, and the average forecast from those Wall Street firms was for US shares to rise 4%, and they fell 19%. No one had that in their numbers. I think there was about 2 or 3 out of 15 that had a negative return, but even then they were very benign negative returns. No one got anywhere near that minus 19% that we actually saw from the S&P 500. Morgan Stanley was the closest, but look, forecasts, take them with a grain of salt. A lot of that strength we've seen in the US this year has come on the back of enthusiasm over artificial intelligence. You've had the big tech sector rise strongly. The big tech index, the FANG Plus index, as they call it, has risen more than 70% this year. So it's been a stellar year. That did come on the back of a hefty decline last year. That index was down 40% last year. So a big rebound for big tech after a difficult 2022. And that theme is super exciting. You know, artificial intelligence, it is a game changer. So don't underestimate how important that theme will be in the years to come. Having said that, some of those share prices are hardly looking great value after the run that they've had. In fact, some of them look a little steep, and a lot of the sort of short term potential, at least, is probably already in the price. So I think one opportunity for investors is to, maybe take a closer look at some other parts of the market, because a lot of parts of the market have been left behind and haven't done nearly as well as big tech or even as the index. Lots of the part of the market's gone sideways or even fallen a little bit. So probably are a few rebalancing opportunities for people. If you're lucky enough to have ridden that sort of AI wave, there might be a chance to just do a bit of fine tuning. That's something you need to talk to your advisor about. It's not something I can give you a broad brush piece of advice around here, but it is something I would be talking to my advisor about at this juncture. So that's share markets, all had a pretty good year. Conservative assets have also been pretty solid. So when I talk about conservative assets, I'm talking about bonds and fixed income, which has done pretty well this year here in New Zealand. Corporate bonds are up 3% or thereabouts for the year, which is certainly a better return than we saw in 2022. In fact, in New Zealand, that's a better return we've seen than the New Zealand share market. So that's good. And I think the lesson you take from all of that is, stay invested, at least partially, even when there's lots of reasons to be nervous, lots of reasons to be cautious. It would have been highly tempting at the end of 2022, after a year like that, to head for the hills and just sit right on the sidelines and not be invested. But those who have stayed the course have actually benefited from a fairly healthy rebound. So, I think it's just a reminder that you never know when markets will turn. You never know what they'll do next. It's dangerous to be overly optimistic and be sort of all in, but it's also dangerous to be, taking a big bet in the other direction. So it's one thing to sort of position yourself cautiously or defensively, which is the term we use for just playing it a little bit safer and maybe being a bit more cautious than usual. So it's one thing to take that sort of approach, but you still need to hedge your bets in case you're wrong and things don't play out as badly as you expect, in case the recovery arrives quicker and stronger than you expect, in case markets are a little more resilient. So I think that's an important message. Looking ahead to the second 6 months of the year, there is some room for optimism. Look, you've got inflation that's coming down. In the US, it's sitting at 4% at the headline level. A year ago it was 9%. In New Zealand, we're at 6.7. We were 7.3 a couple of quarters ago. I think we'll drift lower as well, and that's something you're seeing in most parts of the world. So inflation's coming down. Supply chains have improved in terms of them not being quite as blocked, and you're starting to see more evidence of labour markets beginning to ease. We've seen that in the US in terms of their unemployment rate just ticking up a little bit. It's still low, but it's sort of on a month-on-month basis rose by the most we've seen. It was the biggest sort of increase we've seen in years, actually. We've seen initial jobless claims running higher than we've seen in a couple of years. We even got some employment confidence figures here out in New Zealand earlier in the week, and they pointed to an easing labour market. So some of those things that have plagued us and kept inflation so high in recent times are just starting to turn, which is good. Central banks, it's an interesting bag there when you look across the board, a bit of a mixed bag. You've got New Zealand, where the Reserve Bank may well have done enough. They have in their forecast that the peak is at 5.5%, which is where we are now in terms of the OCR. So based on their numbers, they're at the top. They don't need to do any more. The US, The Federal Reserve has two more rate hikes in their figures, but financial markets are probably in the just one more camp. So time will tell. I think they're very close to the top as well. The UK, Australia, and Europe still got a bit of catch up to do. Didn't start raising rates, well, at least in Aussie and Europe, at least. Aussie and Europe sort of behind the eight ball, so they've still got a bit of work to do. The UK has still got that inflationary issue. So all of those central banks still have some hikes to push through, but they're getting there. They're absolutely getting there. And by the end of this year, they should have done enough. So I think all of that bodes pretty well for conservative assets like bonds, and particularly here in New Zealand. If you believe that the central bank, the Reserve Bank, has done enough in terms of the OCR hikes, and if you also believe that there's a bit of economic uncertainty ahead, and maybe things just start to wobble a little bit in terms of the economy and activity, then you would be expecting bonds to have a fairly good run. They usually prosper when interest rates stop rising. They usually do well when you're in a period of economic uncertainty. And if we look back at the 5 examples of a Reserve Bank pause since the OCR came into being back in 1999, in every single case, fixed income has delivered positive returns in the 6 months, 12 months, 24 months following those points where the Reserve Bank stops tightening. So history is on your side when you think about fixed income. So that's good. For most investors, fixed income is a fairly big part of the portfolio. So it's good that we're seeing opportunities there. And again, not investment advice, but talk to your advisor if that's something you want to hear more about or look at for your personal portfolio. So that's bonds. Share markets, it's much more difficult to predict how the rest of the year will go. Will that resilience that we've seen during the first half continue? I honestly don't know the answer, but here's a few of the things that we're thinking about, or I'm thinking about at least. Markets have weathered a period of rising interest rates. That's good. They've managed to hold their own and prove more resilient against that backdrop of rising interest rates, much more than many people would have expected them to. But you've got a lot of leading indicators, and leading indicators are some of those sort of economic signposts that sort of give you a good heads up about what the future holds. A lot of those leading indicators, well, in fact, just about all of them, point to weaker activity, if not recessionary conditions ahead. And that's the case whether you're looking at the US or places like here in New Zealand. So some would argue that financial markets, share markets are forward looking, and that's no surprise. They see that, they see the data like we do, and all of that's in the price. And then there'll be others who will say, hang on, monetary policy tightening acts with a lag. We haven't seen the full impact of all of those very sharp interest rate hikes of the last 12 months, 18 months come through in terms of the impact on the economy, the impact on economic activity, the impact on sort of consumers, borrowers. We haven't seen all that come through yet. So, we've still got a bit of pain and suffering ahead of us. So, be mindful. And those are both good points. That latter one's a particularly relevant point this cycle. That's always the case, that monetary policy lag. But remember that interest rates have risen at a faster pace than we've seen in decades over these last 18 months. We've never seen the OCR rise as quickly as it has over the last year and a half. And in the US, we haven't seen the Federal Reserve crank up their policy rate as fast as they have since the Paul Volcker days, in the late 1970s, early 1980s. And remember sort of how that ended. So don't underestimate the speed with which you've seen these monetary conditions tighten. And because of that, there's even more of a lag because it's been such a sharp uplift. So here in New Zealand, we definitely haven't seen the full impact of those higher mortgage rates because, at times in the past where you've seen rising interest rates, they've risen much more steadily and slowly. And you haven't had that sort of disconnect between what the people on fixed rates are paying and what's actually sort of happening in terms of the new current rates. So got to be mindful of that. There's also the small matter of the election in October, and usually this almost always sees a more cautious tone emerge amongst businesses, amongst consumers. A lot of decisions get put on ice until the policy landscape becomes clearer. When you don't know who's going to be in power, you don't know where the goalposts are going to be. The easiest thing to do is just sit back and wait. So you just let's shelve that decision. We'll wait and see who's in power, wait and see what the policy landscape is going to look like, and then we'll box on. So I think that that will mean that you have a bit of a lackluster year in terms of sort of business confidence and decision making, and that will just keep activity, it will limit activity over the next few months, and then I would think and hope and expect that after the election, regardless of who gets in, you will have a bit of pent up, activity that needs to sort of come through, because businesses aren't just going to pack up shop because if they don't like sort of the outcome, they'll still need to get on with things, and they will get on with things. But at the moment, it's just easier to maybe sit on your hands a little bit. I think you're seeing that from businesses, consumers, and investors across the board. So that's something that will just weigh on activity here in New Zealand, I suspect, over the at least the first half of the second half. So the third quarter at least. So that's kind of where we're sitting. It's been a really good first half of the year, but as for the rest of the year, the jury's out. We should feel confident about the prospects for conservative assets. I think there's less risk, there's more certainty about what they will do from here. When it comes to higher risk assets like shares, like property, I think you do need to play it a little bit safer. But bear in mind that markets over the long term usually go up. If we look back at US shares since 1950, in the 73 years, so I'm including 1950, not this year, but in the 73 years since the start of 1950, US shares have been up in 52 of those. So, that's a hit rate of 7 out of 10. A little more than 7 out of 10 times the market will be up. So those aren't terrible odds. And over that period, I've only been able to find 3 occasions where we've seen 2 negative calendar years in a row. The last time we saw that was in the early 2000s. So it's not that often that you have 2 bad years. Last year was a bad year. So, what are the chances of this year also being a bad year? You'd say pretty low, given that we're up sort of 13 or 14% in the US market at the halfway point. But the odds are on your side that this year will be a much better year, and certainly a positive year relative to last year. And when you have a positive first half, 76% of the time, going back to 1950, you get a positive second half. So more often than not, if you've got to have a good first half, you probably have a good second half as well. So the odds aren't terrible. So look, play it safe, but don't stay on the sidelines completely, because there is every chance that things actually go okay. I'm very conscious that even though we've got all of these economic indicators that have worked plenty of times in the past, we also haven't got many examples of when we're coming out of a global pandemic. So there's no playbook on how the economy and financial markets will emerge from a pandemic. Those conditions are unusual. Unusual in the fact that you switch off the global economy, that you have all of that stimulus happening at the same time, that people are able to sort of build up a lot of those savings and then wind them down, that you have such a shift from services to goods and then back to services. There's a whole lot of nuances about the last 2 or 3 years that are just very different to what we've seen in traditional economic cycles. So that doesn't necessarily mean that those traditional signposts won't work. We respect those, and I put a lot of weight on what those indicators are telling us. But you've also just got to be conscious that they might not be quite as useful for predicting the future this time around. So they might not be as good at predicting the quantum of any decline in output or getting the timing right. It's been a very oddball period. So just bear that in mind. And there is there is a genuine chance that things don't turn out as bad as expected. And if that's the case, then another bout of volatility that you might get over the second half of the year will bring opportunities for those who keep a positive mindset. So um, that's just a bit of a teaser in terms of what I'm thinking about as we sort of move into the second half of the year. Will it be as good as the first half? I expect not. I'm not expecting to see US shares up another 13 or 14%, but at the same time, I think we want to hedge our bets and make sure that we are positioned for a potentially more resilient period than simply expecting the wheels to fall off completely, because that won't necessarily be the case. So as always, hedge your bets, talk to your advisor, make sure that you have got your bases covered. But those are some of the themes that we'll be watching and thinking about as we move into the second 6 months. So thanks for listening. As I said a few days ago, I'm going to take a break for a couple of weeks. School holidays pretty much at the end of this week, and so I'll be taking a bit of time off. We will talk again in 10 days or a couple of weeks. So looking forward to that. Thank you.
For more insights, visit craigsip.com.